Hello, everyone. My name is Taylor Lane. I'm a banking and finance student at Johnson C. Smith, graduating in 2019. Today, we'll be discussing the fall of the market in 2018. First, we're going to talk about the mortgage crisis, the credit crisis, the bank collapse, the government bailouts, and phasing the frequent appearance in the headlines throughout the fall of 2018 of 2008. A period which is major, which a period in which the majority of financial markets lost 30% of their value. This period also ranks among the most horrific in U.S. financial market history. We did actually go into a recession over this. Um, those who those who lived through these events will most likely never forget the turmoil. So, what happened exactly, and why? So we're going to read on to the subprime loan mortgage market beginning in 1999 played a significant role in the staging turmoil that would unfold in just 9 years later. Unprecedented growth and consumer debt. Subprime Subprime mortgages are mortgages that are targeted at borrowers with less than perfect credit and inadequate savings. An increase in subprime loans borrowing began in 1989 as the Federal National Mortgage Association, widely referred as Fannie Mae, began concerning efforts in making home loans more accessible with those who have lower credit and saving that lenders typically require. The idea was to help everyone get their slice of the American pie, the American dream, if you will. Since these borrowers were considered high risk, their mortgages had unconventional terms that reflected in that risk, such as higher interest rates and variable payments. They also offered type of payments where it was instead of you making 1 month payment, you would make payments out of your check. So every 2 weeks or every week, you would make a payment. Um, while many saw this as a great they saw it as a great propensity to buy subprime markets began to explode. Basically, it sent red flags and potential danger to the economy. Bob Preach, the founder of Elias Wise International, considered and argued that out of control mortgage markets were threatening the U.S. economy and the whole industry and deepened the ever-increasing poverty values. As of 2002, the government-sponsored mortgage lender Fannie Mae and Freddie Mae had extended more than $3 trillion into mortgage credit. In the book Conquered Crash, Preacher stated confidently, "It is only holding up a house of giant. It's only holding this giant house of cards up." The Fannie and Freddie also repurchased mortgages from lenders who originally made them to make more money. To make more money on the mortgage notes are paid, thus ever increases the mortgage, the default mortgage rate, crippling the revenue of these two companies. Learning that Fannie Mae, Freddie Mae, and the credit crisis of 2008 among among the most lethal of the mortgage offerings was subprime borrowers who were interest arms. If everyone knows what an interest arm is a type of loan that is given to people with lower credit ratings, and it is seen to where that you're going to have a low interest rate. You're going to have an okay interest rate at first, and then it's going to get higher and higher and higher until you pay it off. But at the end of it, you're going to be paying the highest end, and at the beginning, you're going to be paying some of the lowest ends. So your interest rate may go from 3% to 10%, back down to 4%, then back up to 30%. it also made it hard because they also had armed payments to where you would have to pay maybe $500 this month, and then $1,000 next month, and then back down to $300. And they both had adjustable rate mortgages. So an adjustable rate mortgage is known as an ARM mortgage. Both of these mortgage types made it lower initial payments that were due at a fixed rate mortgage. Um, After this period of time, often 2 or 3 years later, the arms would reset and the payments then would fluctuate as monthly or becoming larger than the initial payment. This would actually push people out of their homes because people didn't expect this. They weren't really told this. They didn't really have the financial, I guess, knowledge that they needed to understand this. In the uptrending market extended into 1999 to 2005, these mortgages were virtually risk-free, as a borrower had a positive equity despite a lower mortgage payment since his or her home had increased in value since the purchase date. This could also sell the home for a profit because the U.S. marketplace was seen as, if you buy into the real estate, if you buy into real estate and you keep buying into real estate, you're gonna initially make money because your house is going to be worth equity. You're going to have equity in something, and that's always going to be a positive. Um, since and then back to this, so it would create equity since the purchase date, and they could sell their home for a profit, and he or she had not afford future higher payments. However, many argued that creative mortgages were the disaster waiting to happen in the event of the housing market downturn, which would put owners in a negative equity situation and make it impossible for them to sell. The reason it was impossible for it to sell because there was too much saturation in the market. If 800 people sell their house all at the same time, it's going to make it hard because there's not going to be 800 buyers in that marketplace for those homes. And then also, the houses weren't worth as much as the payments. So they may have been selling a house that was worth 700,000, and they may have only gotten 5,000 for it, or they got a fraction of their house which they were paying on it, which was worth nothing. And this also took on to the potential mortgage risk and the total consumption of debt in general. The astronomical rates in 2014 hit $2 trillion for the first time. It's a see said by Howard S. Dorkvans. He said it's a huge problem. You cannot be the wealthiest country in the world and have all of your countrymen being up their neck in debt. That just doesn't make sense. The subsequent of the rise of creative mortgage-related investments. During the run-up of the housing prices, the mortgage-backed securities, the MBS market, became popular in commercial investments. The MBS pool is a pool of mortgages grouped in a single security. Investors benefit with the premiums and interest payments on individual mortgages it contains. So people were basically buying a portion. They were buying a lump sum of houses. So they may have brought up maybe 1,000 mortgages grouped together, and it might have and what made it such a smart idea was people assumed that all of the mortgages were good and all of the investors were sound and going to pay their bills on time. But they even were backed by a triple business rating, some of them. And what they would do is they would put maybe 10 or 11 great houses, great people who were invested, strong payers, and then they would mix in everybody else on the low interest who weren't expected to pay it. So when you looked into the first couple of them, you'd been like, "There's sound investment, is that and this that and the third," and it was backed by the Better Business Bureau. So investors would come from overseas and buy up these properties at a premium, and they would get the interest payments from every mortgage, and they would also get the housing prices for the homeowners that continued their mortgage payments. But however, it became too real as home prices began to plummet and homeowners began to default on their mortgages, which drove everything down. Another popular investment vehicle during this time was the creative diversity, the credit diversity diversity as a credit default swap, which is a CDS. A CDS were designed as methods on hinging against companies' creditworthiness similarity insurance. But unlike the insurance market, the CDS market is unregulated, meaning that there is no requirement for issuers of the CDS contracts to maintain enough money in their reserves to pay out the worst case scenarios. So that's what happened to AIG, the American International Group, when they were insuring all of these loans and all these other things. They didn't back up their money at all. They were out spending it all. They weren't backing it up. So when worst came to worst in 2018, they announced huge losses and that their underwrite CD cases that they could not even afford to pay on them. The market declined in March of 2018. In 2017, this was a great thing. I hope the market declined in 2018. It failure to bear stern and a huge losses and involvement in the underwriting. I hope I hope this has taught you a little bit about 2018, well about the 2008 housing bubble, and also about the Great Recession in 2007 to 2010. I hope this has seen you well. Class, you are dismissed.